Task 5, AAT Practice Assessment 1 for preparing financial statements. So this first task, 5A.1, asks us to identify the principle being described in each of the following scenarios. So the first one, value of goods sold but not yet paid for at the year end is included in sales for the year. Okay, so remember that when we're doing accounts, we've got to make sure that the revenue and the expenditure is matched in the year that they took place, not the year that they was paid. Okay, so sales that relate to financial year 2023, for instance, have got to be shown in 2023, but they may not be paid until 2024. Okay, so it's got to be in the year that the item took place. So on that, this would then be called the accruals principle. So we are making sure that everything relates to that financial year. The next one, Rena takes a card from a business for her own personal use. Well, first of all, you've got to remember that the business and the owner should be classed as separate entities. So what we need to think is that the business, any transactions in the business should be recorded separately to the owner. So with that in mind, this would be the business entity principle. The next one, it's saying stationary items such as staplers are treated as expenses rather than non-current assets. Okay, so remember, non-current assets are capitalised, usually because of the value of the item and because of the length of time that it's used by. So if it's a motor vehicle, it may be used over 3 years. And because of the value, it would be capitalised. With stationary items such as staples, staplers, paper, etc., because the value is so low, this is what we call the materiality concept. So this basically says anything valued at a certain level goes through the profit and loss. The next one then, non-current assets are depreciated. So if non-current assets are to be depreciated, it's so that we show a true and fair value within the accounts. So we're not overstating the value of the assets on the statement of financial position and so on. Okay, so it also means that if we're going to depreciate, the business is going to continue. Okay, so this is the accruals principle and the going concern principle. Okay, so we're saying that we're depreciating it to get a true value and the business is going to continue trading. The next one then, it says identify each of the enhancing qualitative characteristics being described below. Okay, so when knowledgeable and independent observers can reach consensus that the information is fairly represented. So this is somebody else coming in, looking at the accounts, making sure that everything's being done according to the policies and principles, etc. So they are basically verifying what you've done as an accountant and saying, yes, they are correct. So this is the verifiability term that we use. When information is clearly and concisely classified, characterised and presented, this does not mean that complex information should be excluded. So this is about putting together the accounts and explaining them in a way to different levels of people or what they're actually telling you. Okay, so for instance, a finance manager might want to know what the profit for year is and how that profit for the year is compared to budget. Okay, so it's making sure that the information we provide to users is understandable. So for instance, a sales manager, for instance, doesn't want to know what the admin expenditure is of the admin staff. He'll want to know what it is for their sales team. Okay, so this concept or term is basically the understandability term, making sure that people that are looking at the accounts can understand it. However, we're not leaving out important information. So section B. Then. So identify whether the following statements about profitability ratios are true or false. Okay. So profitability ratios basically tells us how the business is doing. Okay, so interpretation of an entity's financial statements using ratios is only useful for potential investors. Well, that's got to be false, because we would look at ratio analysis and we'll look at profitability ratios to ensure that the business is doing what we need it to do. Also, employees might be interested, making sure that they keep their jobs and the business is still viable and it's making a profit. In order to provide useful information, ratios need to be compared to different organisations, different time periods, or industry standards. Okay, so if, for instance, you're talking industry standards, that might be, for instance, the steel trade. The steel trade will have an industry standard on what the price of steel is and the import costs, etc. Okay, so you're comparing one business to another, but you're also looking at the industry as a whole to find out what's actually happening to the steel industry. Okay, so we want to compare financial information with others, especially competitors, because we want to see what they're doing and how we're doing. However, you've got to be realistic. There's no point if you own a small shop, convenience store, there's no point comparing that to likes of Morrison's or Asda. Okay, so it needs to be comparable. But yeah, this is true. We do need to compare so that we can see whether, for instance, you could look at the gross profit ratio and compare it with other companies in the same industry and see whether the ratios are similar. So that's a good way of looking at it. A disadvantage of ratios is that they are based on previous performance, which may not be valid for making predictions about the future. Okay, this is true because we're looking at what's actually happened. So, for instance, if you think back to when it was the pandemic, a lot of businesses comparing ratios then to now, it would be totally different. Some it'll be better because of what they provided, like PPE, etc. But others, such as hairdressers, beauticians, it'd be a lot worse than what it is now. So you are comparing what's actually happened. So it doesn't always give you a fair view of where you are at this moment in time. All other things being equal, if gross profit percentage increases, then net profit percentage will decrease. Well, if gross profit goes up, okay, that means that it could be things like your purchases are cheaper than you expected because you may have got a new supplier or you may have got arranged new discounts. So that doesn't then necessarily mean that your net profit's going to decrease because your gross profit's increased. It's increased because there's either, I don't know, sales revenue could be higher, but purchases could be lower and so on. Okay, so your net profit comes from the gross profit less your expenses. Okay, so that one's false. Okay then, so moving on to the next one. So this is a couple of calculations for ratios. Now, return on capital employed. So this is basically saying that for the profit, what percentage are we making compared to the capital employed. So to work out your return on capital employed, it's your capital 136,400 plus your non-current liabilities of 97,500. Okay, so to work it out, you've got your profit stroke loss for the year, divide it by the figure that you've just calculated, which is that one and that one, which gives you 233,900. So 59160 divide by 233,900 times by 100 gives you 20. What did I work it out? 25.29%. Okay. Net profit margin. Remember, this is your profit for the year, so that's your net profit. Divide, and then you need your sales revenue. So your net profit divide by your sales revenue times that by 100 gives you 13.96. Okay, so as long as you can remember the ratio, what figures you're using in the calculation, the rest of it should be quite simple. Okay, next task then is 5C.2. Okay, it says shop wages, that's the important bit. Okay, so shop wages there as a percentage of revenue has risen from the previous year. Identify whether the following statements in the rise are true or false. The rise could have been caused by the business taking on a new person in order to stimulate growth. Okay, so if you're taking on a new person, that means you're going to be paying them a wage. Okay, so if you're paying them a wage and there's been an increase in revenue, yeah, that would be true because you're taking on that person to generate that revenue. Okay. The rise could have been caused by revenue rising during the year due to increased advertising. No extra staff were employed in the shop. Well, this has got to be false because it states in the data that shop wages as a percentage have risen from the previous year, but you're taking on new staff. So it's not, if you're taking on new staff, that's where your wages increase. Okay, your wages don't increase just through advertising. Okay, advertising would be an expense rather than a wage cost, so that one's false.